It's Daphne Jones, the Smart Money Chick, and I came in to talk to you about the five critical components of term life insurance. So, term life insurance is the purest, simplest form of life insurance out there. It doesn't carry any, it doesn't accrue any cash. It doesn't have any investments attached to it, or the type of way. It doesn't accrue interest and things like that. So it's basically a contract between the insurer, which is the person purchasing the policy, and the life insurance company. And so the five parts that one would have to worry about or know about is one is the term, is how long is the insurance policy in force if premiums are paid, and that can be anywhere from 5 to 30 years. It's the policies, a term life insurance policy. The reasons that they're pretty inexpensive. If you hear commercials like $50,000 for a 30-year-old man would be like $22 a month or something. A 30-year-old man would be something like $22 a month. Has to do with the fact that the insurance company is betting that during the life of the term, during the life of the policy, the life of the contract, they won't have to pay. So that's why you can buy a large amount of coverage for a small amount of money. It's a great way to get started life insurance. So again, the term is a set amount of time. As long as you pay the premiums, you have life insurance. They will pay a death benefit to your beneficiaries. So death benefit is exactly what it is. When the insured person dies, if they die during the term of the policy, during the life of the contract, the individuals or entity that they designate will receive the death benefit. And by the way, which is tax-free. So how do you determine that benefit, which is how much life insurance do you purchase, which is often the term? Again, what are you purchasing it for? Is your plan for it to pay off the mortgage? You want to give a significant person in your life X amount of years of income, of your current income. You make $50,000 a year. I want to make sure that they have at least 5 years of actual cash, which is $250,000. Or there's some bills that I want to make sure is paid off, not only just the mortgage, but that can pay off both cars or something of this nature. So, and those are the numbers that goes into calculating the size of the death benefit. The next thing is premiums. Now, most term life policies are level premium. That means that the price that is quoted to you in the very beginning is the price you're going to pay throughout the life of the contract. For 20 years, you're going to pay $17.50 a month. Now, there are some policies that renew annually. That means that the price will go up every year because the older you get, the more it costs to insure you. There are decreasing premium insurance policies. These tend to be tied to like a mortgage or something of that type, where the benefit also goes down. The death benefit also goes down at certain intervals. So you pay less for the life insurance, for the premium. Again, these are like specialty subspecialties. The fourth component of term life insurance are living benefits. This is where you can access a portion of the death benefit while you're still alive. One that's universal is terminal. When you have a terminal illness, a doctor has stated you have 24 months or less to live, and you can access a portion of the death benefit. Not all of it, but a pretty good portion of it, and you can use that money for whatever you want. And it is still tax free because it's the benefits of a life insurance policy. Also, another one that is universal is when you need like skilled nursing care. because you're no longer able to do some of the daily features of life, like being able to get to the toilet or to dress yourself or to feed yourself. And you have to bring someone in to do that. Again, you can access a portion of the death benefit to do that. Now, when you do access your death benefit, when you do die, there's going to be less money there. So whatever money you use while you're alive is subtracted from the death benefit. So it does shrink the benefit. And finally, what we have, and we're going to talk about beneficiaries. Now, beneficiaries are the individuals who you designate to receive the death benefit upon your death. It can be an institution, like you can leave money to your school. You can leave money to your church. You can leave money to some charity. That's fine. If you leave your money to a human being, please make sure they're 18 or older. Insurance companies will not issue funds to someone who is under the age of 18. And if you don't designate anything or have anything set up for the individual, such as like some type of custodian or guardian, the state, a judge will determine where the funds go and things like that. So, will determine how they're going to be protected. The person you designate who's under 18 will eventually end up with the funds. It's just that, there's going to be expenses having to deal with the guardian and cut court costs and things of that nature. So it's best to set up some type of entity, either a person themselves or a living trust of some type. Nope, not an attorney, but I do know that much. So not giving legal advice. So if you have any more questions or you like to learn more, the big picture of life insurance, I've got an ebook I wrote. It's called the Big Picture Guide to Life Insurance. I'm going to have the link below. You can click it and put in your email address, and you'll get it immediately in your inbox. So I look forward to hearing from you. So whatever platform you see this on, hey, drop a comment. Let me know. If you're catching it on YouTube, give me the thumbs up and subscribe, or thumbs down. Just interact with the video because I love to hear from you. Send me some questions. If there's some more things that you want to know, and particularly about money, life insurance is my specialty. And I am Daphne Jones, the Smart Money Chick. And it's been great talking to you. Thanks for giving me your time. Bye-bye.